Well, howdy there, folks. A couple of videos I want to react to here. This is a generational buying opportunity, says Dan Ives. I want to watch that together. I want to give my opinion on this. I agree. I think it is a generational buying opportunity. I think 2022. With that being said, I want to hear what he has to say specifically, and I want to give my points off of that. This one I want to watch as well. Be very selective in buying stocks right now, says Steve Weiss. So maybe a little counter argument. I want to really hear what both these folks say. Now, let me address an elephant in the room before I get into this video, because I've heard it. A lot of people are wondering kind of what's going on with my situation, right? You know, I record these videos outside, then I record videos in the garage, and a lot of people are concerned. They're like, am I allowed back in the house and things like that? And yeah, I'm allowed back in the house. As soon as the Nasdaq's down less than 20% year to date, I'm allowed back in. So don't worry about me. Weather's still pretty decent here in Vegas. It is gonna get hot soon, so we do need this Nasdaq to get moving in the right direction. But do not be worried about me, guys. I will be just fine, and I'll be in there, you know, eventually. And let's just hope this market turns. Okay, I hope you guys enjoyed that as always. And yeah, let's jump into this. Also, if you're looking to join us in the private Discord chat, researching companies, talking about companies, all those sorts of things like that, access all the course curriculums. Check out it's going to be linked in the description if you're looking to become a member in there. Alrighty, let's go.
Wedbush analyst at Post 9 to make his case. You really think this is a generational buying opportunity?
Well, I think for the right stocks, but because our viewpoint covering tech since late 99, in these downturns, you got to separate the froth from what we believe are the names that are going to be able to navigate. And
that's an interesting time to start. 99, right at the end of the tech bubble. Oh boy.
Valuations that we believe are way oversold. So I look at software, cybersecurity, I look at names like Microsoft, you look at names like Amazon, Apple, among others. That's why to us, we're not just going to sit here and say you paint them all with the same brush. It's a bifurcated tape.
Okay, let's talk about the mega caps.
Okay, first off, a generational buying opportunity, and he mentioned Apple and Microsoft, okay? You know, there's a lot of dang stocks in this market that I feel are generational buying opportunities. I mean a lot. But damn it, come on, Apple and Microsoft, like those ones have held up the most well. They're trading at higher P's than they're usually trading at. Like, of the stocks you could have said, you know, and we'll see what else he has to say here, but of the stocks you could have said, like, you know, you could have said Meta, Amazon, okay, I agree with that one. You could have said PayPal. You could have said so many various stocks. But to say Apple and Microsoft, come on. That is such a generic answer. I'm like, oh my gosh, like those are not generational buying opportunities right now. They are not. You know, maybe many years ago they were, but not today. Apple and Microsoft, could they make you money over the next 5 years? Sure. But are they generational buying opportunities? Heck no. If I hear the word generational buying opportunity, I think of that sort of opportunity in the market where you're going to make an absolute killing over the next 5 years. You are not going to make an absolute killing in Apple stock over the next 5 years, nor in Microsoft stock. You might do decent, but you're not going to make that sort of money. And there's a lot of stocks in big tech that you do have those sorts of generational buying opportunities that are trading at not just 52-week lows, but are multi-year lows. Apple and Microsoft are not at multi-year lows. Almost everything else in big tech is at multi-year lows. You have to go back to like 2018, 2017, 2016 for a lot of these stocks. That's where the real opportunities are. So, you know, that's just a disappointing start. We'll see how all this goes from here, but that's just disappointing.
Specifically, because who's to say that these stocks deserved to be where they were before this recent sell-off? I take a look and I raised this issue, and I asked our team to put these numbers together because I wanted to raise this with you. If you look at where the PEs were for all of the mega cap all-stars, right? From the pandemic low, let's call that March 2020, okay? Apple's PE was 17. All-time high S&P, it got up to 30. Microsoft 23 got to 34. Alphabet 22 got to 25.
This is... Okay, so first off, I actually usually like this guy who's asking this question here. I think he actually, on CNBC, is one of the better guys at asking questions. This is just plain... I don't want to call it stupid because that's a little disrespectful, but this is just nonsense. You don't compare to a time when people thought the world was going to be closed down for 3 years. Like, to compare and say, oh, you know, it was trading at this valuation, so this is the valuation it should trade it at in the March lows of 2020. Come on, man. Like that makes me like roll my eyes. Like, that's got to be a joke, a complete joke. And then they compare it to their highs they reached, I guess, at the beginning of this year, because ever since then, obviously, the NASDAQ's been down. Like, as soon as this year started, 2022, the new year started, this NASDAQ just crashed, right? And so I'm looking at this, and I'm like, this doesn't make any sense. Like, this is just a horrible comparison. Like, that you don't compare stuff like that and say, well, it was trading at this at the lows on March 23rd, 2020. Like, no, like, what are we doing here?
NVIDIA from 27 to 58. The point being that a lot of these stocks, if not the whole group, got that burst because of all that the Fed was doing from liquidity, right? Now that the Fed's pulling that liquidity away, why shouldn't these stocks go back to where they were around the time that the Fed injected this liquidity? These stocks didn't run up in the manner in which they did on fundamentals, did they?
And that's a great question. That would be a big debate. And ultimately, I just view it as fundamentally, when I look at the trends over the next, call it 2-3 years, when I look at the cloud trends, I look at semis, I look at AI, I look at what I believe is the fourth industrial revolution. You stress test these numbers. Look, this is the fundamentally different. The buy side, they're already looking now, 2023 numbers, assume mild recession ahead of the sell side. So my point is that numbers here...
See, if you want to talk about generational buying opportunity, one, you got to start with smalls and mids, in my opinion, because those are trading at literally generational type opportunities. But I know a lot of people don't like smalls and mid caps, okay? They can't consider those. They can only consider the biggest of the big companies. Okay, if you only can consider the biggest of the bigs, this is where your real opportunities are in this market. If you want to talk about generational type buying opportunities and you want to look at, big dogs, that's where you got your real opportunities in this market, not Apple and Microsoft. Secondly, this guy's not putting up nearly a good enough fight, in my opinion. Like, I would have tore down this other gentleman's kind of argument here, where it's just like, it's ridiculous to compare it to lows and they're trading at this and it's all just based upon Fed. No, the fact is, all these companies, all these big tech companies, reported unbelievable numbers, okay? Absolutely extraordinary, nothing short of extraordinary numbers. The growth rates from the back half of 2020 through basically the end of 2021, the growth rates, Apple, Amazon, Google, all those companies you saw in front of yourself, Meta, Netflix, all those companies, the growth rates those companies put up, never mind you can go a tier lower to the Shopify's, Adobe's, all those companies, the growth rates were ridiculous. And so that caused Wall Street to get a little too hyped in terms of what they thought the realistic numbers were, right? And that's because everybody was at home. You had stimulus money pumped out there, plus coming off of easier year-over-year comps. It all was kind of this perfect kind of super cycle. Now we got a situation where a lot of these companies are reporting disappointing numbers. Facebook, Amazon, all these stocks, basically, almost all of them, like the majority of them, right? So now people are starting to try to value them at these really low growth rates, and it's like, that's not how you need to value these companies either. It's something in between what you saw kind of in, let's call it 2021, and what these companies are reporting now in 2022. The growth rate is somewhere in there, roughly. So let's say a company was growing at 40%. Now they got, 5% revenue growth. It's not 40 and it's not 5. It's somewhere around like a 20-ish is where I would call it, which is similar to, like, if you look at Amazon, Meta, some of these companies, they've been putting up these horrible numbers. They were also coming off of years where they were comping some ridiculous numbers that were way extraordinary from where they were growing at. So now Wall Street's gone way too low to the downside, right, here in 2022, and they could go even lower, but they've shot way too far, as they shot way too far on the upside as well, okay? So I think that would have been a good point of attack here, in my opinion, from this guy. So.
I mean, if you look at MFANG from an EBITDA perspective, 12 times, you're starting to look toward what I go almost be market multiples for what I view as probably the best growth names across tech.
But say, like, these stocks were used as, in some respects, bond proxies. In, I think, a large respect, defensive plays in an uncertain world during the pandemic. Can you make the argument to me today that Apple deserves to be at a 30 PE? Or does it deserve to be closer to the 17 where it was before the Fed put all of the punch in the bowl?
Okay, so that's a good example. Let's just look at Apple.
Yeah.
The services business is a different business today, and I believe going forward, than it was 2 years ago. So you're talking about an $80 billion revenue stream that basically has been a big part of the re-rating in Apple. And it's always been my contention, Apple's a name. When you look at it as straight PE, instead of some of the parts in terms of looking at services and hardware, you ultimately, what I believe is, undershoot what should be the core valuation. So my point here is that I'm not saying the froth, the web vans, the global crossings, what we saw in 2000.com front and center, that's not going to happen. I'm just saying you have to separate the have and have-nots, and valuation here relative to when we go back to 08, 09, and even 01, 02, relative to growth, we view now as the time for the names that we've talked about in our tech playbook to own them.
But is Apple's services business 13 points of valuation better than it was 2 years ago?
Well, I think, and I think when you look at Apple services business, you look at the growth, you look at ultimately the margin on the services piece. I think it's something going into the pandemic, the market was basically assigned. Now it's worth $400 billion. And at one point in the pandemic, we're looking at 1.5 trillion. So I think a big difference with some of these names, I'd argue the same with Amazon. Some of the parts, what's the cloud business worth? With Google, I'd argue right here, you're assigning minimal growth and minimal valuation to the cloud. You stress test numbers on the other side of this, get every bear argument out there. But it just comes down to, like, Scott, we've talked to 25 of our checks this week, CIOs, product managers trying to understand spending.
Yeah.
Stress test these areas, it's firm. And that's why we'll cut. Now, you'll see numbers get cut because the street will ultimately assume a mild recession.
All right, so, in regards to Apple, let me just touch on that before we get to this video. Be very selective in buying stocks and hear what they have to say here. But, Apple, many, many years ago, used to always make an argument that Apple was one of the most disrespected stocks in the market, and it shouldn't be. And I used to make this argument that Apple should be valued similar to like a Clorox, a Procter & Gamble, a Johnson & Johnson, because it's just as safe as those business models. Like, if my iPhone breaks, I'm going to buy another iPhone. It's not even a question, right? In their services business and all those things as they were growing over time. If my MacBook breaks, I'm going to buy another MacBook. If anything, I feel like Apple's almost a safer business model, and we'll see what happens if they get disrupted by potentially metaverse or something like that. We'll see what happens with that. But as of today, at least, that's just as safe as business model as any of those other companies, or Coca-Cola or Pepsi or something like that. So it should be valued somewhere roughly in line with those companies. Like I said, when it comes to like Apple, I don't feel that as like this is a great, you're stealing money if you buy Apple right now. There's a lot of stocks in the market right now that I feel like you are stealing money if you buy those stocks and hold them for the next 3-5 years. I don't put Apple in that category. I think Apple's fairly valued. I don't think it's undervalued. I don't think it's necessarily overvalued. I think it's just in line with kind of where it should be, to be quite honest. So lots of that. Let's jump into this one now.
Our market bounces of 10% or more in some days and some weeks, and that could be it. Look, as bearish as I am, I've been expecting a bounce. I'm not participating in it because I really don't think they're tradable. And I defy anybody who says they're tradable to tell me how, because the volatility is so huge. Look at yesterday, look at the day before. So we'll continue to see this, but I'm not going to change my thesis because the market's short-term oversold when I think that the conditions that have caused me to be bearish are still in play. And that's very high inflation, as we saw the day before yesterday. That's going to continue. And by the way,
Short Hills Capital. Come on, you can't make up that name. Short Hills Capital. Oh gosh.
Just now is that the Fed won't be able to get inflation down below 4.5% for a year or 2 years. So you're looking at persistently high inflation. It's twice what their target is going forward.
You can't get it under 4.5% for a year or 2 years. I just could not disagree with that statement more. I think it's very possible we could see that by the end of this year. A year, 2 years from now, I just think you got to understand these things can shift so darn quickly, and the year-over-year comps are going to get so ridiculous. And we've already seen so many prices come down for so many different items out there. I showed it in a video recently, lumber and so many, like a million different things, steel, iron ore, so many different things that are dramatically decreased in price versus where they were a year ago. So it's almost comical to see anybody try to predict where inflation is going to be 1 to 2 years from now, because I'm just looking at this year and I'm like, inflation's about to tank down. There's no doubt in my mind, and it's going to tank more and more quarter after quarter after quarter after quarter. We're going to fall to 7%, 6%, 5%, and I think there's a real high probability that within this year we get under that 4.5%. We'll see how it all shakes out, but yeah, to say it's not happening for 2 years is a little misguided in my personal opinion. But we'll see. We shall see.
You're starting to see earnings revisions on the downside. A strong dollar is going to cause that to happen even more with the S&P. So look, as I said before, I'm going to be the last one probably to call the turn because I'm so bearish and I've been so bearish so long.
Does that mean that you're not buying anything in anticipate of a bounce that you say can happen?
No, and in fairness, I just haven't felt compelled, given other stuff that I'm looking at in the private markets, to spend the time doing it. I'm close. I do think you're close to buying selectively some stocks, but not going wholesale in, because you've got private equity valuations in terms of EBITDA and cash flow, free cash flow yields in the market that I think are sort of generational. Doesn't mean they won't get cheaper, but I think you can leg into some of those stocks. You got to be very, very selective.
So, Shannon, I mean, the moves that we...
So, first off, the way that gentleman talks right there, that's a lot of how Wall Street talks. They don't care necessarily about timing the bottom or anything even remotely close to that. They would rather, believe it or not, and it doesn't make much sense to me, but to them it does, right? They would rather see the NASDAQ, let's say, down 30% year to date or whatever, right? They would rather say, I'm not going to buy it because I'm scared we're going to go down to 35% or 40% versus see it go down only 25% or 20%, right? At 25% or 20%, they might jump back in the market. But they would rather that situation than buy, essentially, when everything's dipping. They want to see that almost like confirmation, like we're going up, and not try to catch falling knives. And that's this like the mentality of Wall Street. Once again, that's so much different than my mentality. I love to catch these falling knives all over the place. And if I get sliced, I get sliced. But I would rather pick up the stock. Let's say it's at $2 a share. And buy that stock and accumulate that stock rather than waiting to say, it could go down to 1 or something like that. And then it goes to 4. And maybe at 4 or 5, they start picking it up, right? It's just a very, very different mentality. I can say from kind of the market standpoint there. So.
ARK is up 10% today, right? The ARKK, the Innovation Fund, is up 10% as we're having this conversation. From Wednesday's closed,
but see, a lot of Wall Street doesn't care about that. They're like, I'll buy ARK when we get day after day after day or several weeks in a row of ARK being up. So they would rather buy ARK at 50 or 55 and they're confident it's going to continue to go up than buy it at 37 because they're like, what if it goes to 33? Once again, it's just a different mentality.
Innovation's up 17%, Robinhood's up 31, Roku's up 23, DraftKings 23, Teladoc 16, Twilio 19, Roblox 36. What are we to make of that? Is that where we think maybe this sizable bounce, if you want to call it that, starts, and then it needs some follow through from some other important names that we'll talk about in a minute? But how do you assess it right here?
Yeah, I think the latter part of your point, Scott, is the most important piece, is that this is not going to change the trajectory of how most U.S. investors are going to perform over the next couple of weeks. A lot of the retail investors have moved out of these names already. We are seeing, obviously, some significant dip buying here, particularly today in some of these companies. But in terms of what's going to work over the next couple of years, whether or not you believe that we're going to have 4% inflation, we're going to have higher inflation, we're going to have slower growth. And I think that when you're looking at your portfolio, if the follow through doesn't happen in sectors like industrials, in technology, in healthcare, in the back half of this year, these short-term rallies that we're seeing are not going to be sustainable. So I continue to look at companies that have strong free cash flow, have strong balance sheets, and most importantly, are making money from a profitability standpoint. I think that's when you start to see a shift in the market, because those are the companies that are actually going to drive index returns.
Pete, we made a big deal the other day.
It's so funny hearing these folks try to predict, inflation is going to be super high for years to go in the future. Not to pat myself on the back, but back when we used to do Millennial Money back in the day with Kevin and whatnot, right? And this is like probably over a year ago now. I was talking about inflation, and I was talking about, like what I was seeing in the real world and what I was seeing from, like folks I knew that were in different types of businesses and different industries, and how much inflation those folks were feeling, and how much we were seeing out there. And this is way before CNBC or any of these folks were picking up on inflation. Now they're all so far on the inflation trade that they're willing to predict that inflation is going to be high for years to go in the future. And I'm just like, you are sorely mistaken. You are sorely mistaken if you truly believe that. These things shift very, very quickly. As when these folks weren't even talking about inflation was starting to ramp up and go crazy, right? Now it's already gone crazy, and now they're trying to predict that it's going to be crazy for years to go in the future. It's like, no, that's not the way this whole game works, man. So it's just interesting to see and to make your investment decisions based upon if inflation's at 2%, 3%, 4%, 5%, I think is also a bad long-term decision, because damn it, if there's one thing we do know, inflation, deflation, all that crap's going to move around. What do you think these people are going to be saying if we get into deflation a year from now?
These puts that you had on, right? Remember that? We did your calls early in the show, and we said Pete's got these puts, and they were specifically, or for the most part, related to ARK. I'm wondering, you know, the ARK Financial Fund, talking fintech, the Innovation Fund itself. So where are you on those today, given this move that we've had?
Yeah, I'm still in those, Scott. I did trim again. We talked about I trimmed the other day. I trimmed again yesterday. We hit new 52-week lows again yesterday before this big turn that we're seeing at the end of yesterday and into today. So they're going up enough now where one of mine is going to go off completely. What's left of it is going to go off worthless. It was a great trade, though, and that's the ARK F. Now, the ARK K, I actually have a little bit more time out into the future for that one to perform. So I'm still holding on to what I've got there as well, Scott. But yeah, that put buying was absolutely dead on. They absolutely nailed it in terms of short-term looking for these to really pull back in a big way. That's exactly what happened. But like everything else in this market, you've got to be extremely disciplined. We talk about the velocity of these moves all the time, Scott. Give you a great example of that. And if you don't mind, I'd love to hit the VIX real quick. Everybody said, hey, look, we need the volatility index to hit 40 before we can turn. That may be true still, and I'm not saying that we aren't still in that position, but today, you've got the volatility index back underneath 30, so you're trading at 29. We had 4 times this week, Monday, Tuesday, Wednesday, Thursday, the VXN, which is the volatility index of the NASDAQ, closed above 40 for the first time in a year. Actually, it was November or October of 2020, the last time we were at those levels closing. So we had 4 closes over 40 this week. That gives you a little bit of a sense of, all right, maybe there's a pullback, and maybe that gives the opportunity for these stocks start making a move to the upside on the NASDAQ side. But that was a big jump and a big bunch of closes, Scott.
So there's this big fascination in the market I've noticed about the VIX going 40 plus, and we can't bottom until the VIX goes 40 plus, or, you know, it's just, so my 2 cents on that is, usually if you're talking about VIX 40 plus, you've got to have something that comes out of nowhere that no one foresaw that's just insane, right? So 2008, we saw VIX go above 40. That was in the financial crisis when we thought we were going to lose the entire banking system, literally. We had VIX 40 plus in the Rona crash, right, which all of a sudden out of nowhere, a once in a 100-year pandemic came out of nowhere, right? And we were talking about closing the economy for 3 years. That's what people were talking about at that time. So you can get those sorts of moments, but I don't know if we have any that. We've been on I don't want to call it a slow grind, but it kind of has been a slow grind of many month after month after month where things just get worse and worse and worse. And it's just kind of been like a baking in of bad news on top of bad news on top of bad news on top of bad news, right? And so I look at it and I say, I don't think we need the VIX to go over 40 to bottom. Maybe that happens, but I don't think we necessarily need it. I think it can happen without that actually happening. And people will be wondering what the heck happened in that whole situation. Like, how did this even happen? So anyways, I'd love to know your guys' opinion in the comment section. As always, hope you enjoyed this video. Thanks for joining me. Much love as always. If you want to join the private Discord chat and become a member in there and whatnot, check out the Discord chat down there to become a member. Much love and have a great day.